Hi, this is Azad Ahmed with Dacia Consulting. Today we're going to talk about a very important topic, which is retirement income and retirement planning. So when you are near retirement, you start thinking about it. But even if you're young, it's good to plan and to think about what is available, what are the options for you in order to have a very decent life in retirement. Otherwise, then you may become stuck with a very limited amount of income, and then you will be dependent on maybe your family or maybe the government funding and everything. A lot of people just think, oh, the government will take care of me. Here in Canada, the government has a lot of welfare options for retirees. It's true, there are a lot of benefits. However, there are limited benefits if you only depend on the government. So you need to have also your own planning in place. So in this video, I will go through those concepts which you should be clear about for your retirement planning. So I will mention, of course, first of all, like most people think that the most important aspect of retirement income is to depend on the government pension. And yes, here in Canada, we are lucky. We do get some government pension depending on different factors. The first one is old age security, which I'll talk about later on in more detail. But just briefly, old age security pension is for somebody who is over age 65 or 65 years of age. You can apply for it. You don't contribute into old age security. It's just only through your taxes do you get you are entitled to getting old age security. It only depends on how long have you lived in Canada. So it depends on, you can think about how many winters have you faced here in Canada. If you've been here for 10 years, less than 10 years, you don't get any old age security. You have to have lived more than 10 years. If you lived more than 40 years, yes, in Canada, then you get the maximum old age security pension. So it's only dependent on the years of residence in Canada. And then there's also a guaranteed income supplement, which is extra payment. If you're eligible, you will get that. That is if you have low income. And then there's the allowance, which is for the spouse during the ages of 60 to 64. So I'll talk more detail about that, but keep that in mind. That is one type of pension. The second type of government pension is the Canada Pension Plan or the QPP, the Quebec Pension Plan. You do contribute to it. It's around 5% employer, 5% employee. When you look at your pay stub here in Canada, we pay into CPP. There's a deduction for CPP, and there's also usually deduction for EI, employment insurance, which has other benefits. So for CPP, you do contribute to it, and you will get a retirement income if you retire after having contributed to CPP. So the disability is also a benefit for CPP. If you've been paying into CPP and you're any age, you're 25, 30, 40, 50, and you unfortunately become disabled, that is an extra benefit. You do get some disability payment there, but it has to be severe. And then there are survivor benefits. If somebody is paying into CPP, their family will get some benefits if that person dies at any age. So it could be a lump sum of $2,500, up to $2,500 is one benefit. And then there's orphans and spouses allowance if the person dies. So those are the government pensions or government benefits, two main ones we'll talk about. But then if you should be lucky to work in a company which gives you a pension. So the company pension, usually there's three main types. There's defined benefit, defined contribution, and then there's deferred profit sharing plan. So we will talk about these in the next slides also in more detail. And then you should have saved some money on your own also. Along the years, if you have contributed to an RRSP plan, a retirement savings plan, that is a good idea because you can convert it into a RIF account, which will give you a regular income. You can take some, fixed amount from it. It can pay you a pension also. And then the other is you can have a tax-free savings account, and there's some other options which you should have saved some money along the way in your personal saving. So that way, in this combination of some government pension, some company pension, some of your own saving, and then maybe other sources like you may have investments which give you income, such as suppose investments like interest income or dividend income. That's another way which you can get income from investments. And then there's rental income also. So, but we're not going to talk about those two. Those are a separate thing because those are like investments related, and then retirement, and then rental income. We'll talk about those separately in another video, but I want to focus on these, two or three aspects, and that's mainly the government pensions and the company pensions. So like I said, the first one is the old age security. You don't contribute to it. There's no contribution that's funded by tax. You must have lived in Canada for 40 years. Currently in 2020, it's around $613 a month. So you can't really rely only on this old age security, but it does give you about $613 a month these days. So if you've lived here 10 to 40 years, prorated, in other words, if you live 20 years, you'll get half of that. You'll get around $300 monthly. If you lived over 20 years, you can also get this abroad. If you go abroad and live in retirement there, you can continue to get this payment there outside of Canada. So you can apply at age 65 for the standard amount. If you're now applying, you will get around $600 a month, but you can delay it. If you delay it later, you get it apply later than 65, you will get an increased amount. The monthly payment is increased by 0.6% per month of delay. Let's suppose Alice, she delayed her old age security payment for 14 months. So she will get 14 times 0.6, she'll get 8.4% extra payment. So if it was 613, then calculate 8.4% of that, add it on, and now she'll be getting $664 a month. So in this way, it's beneficial to delay it, but then again, you never know about health, and you don't know about life also. But that is a benefit there. It is taxed. Old age security is not free. You do have to pay taxes on it. The GIS, which is Guaranteed Income Supplement for low-income people, that is not taxed. And again, you don't contribute to GIS. If your income in retirement is over a certain threshold, for example, now in 2020, it's $79,054. If you earn more than that, you're earning over like $80,000 in retirement, it's pretty good. Then you don't need the $600 a month, which is like $7,000 a year. So in that case, old age security, it started to claw back. That is, you have to refund it back when you do your taxes the next year. So you'll continue to get it for 1 year, and then next year you have to pay it back. So let's take an example here. Harry's income is $88,000 in retirement. So 88,000 minus the 79,000, which is the threshold, he's over $8,946 of the limit. So 15% of that, if you calculate it, it will be $1,341. So he has to pay back $1,341 when he does his taxes. The allowance, we said, is the other thing here. So under old age security, you have a pension. That is one aspect here, of course. And then you also have the other is the guaranteed income supplement for low-income people. And then there's two allowances. One is a regular allowance. If the spouse of the old age security person is age 60 to 64, then that spouse gets this payment till they're age 64, then they get their own payment. And the allowance is for the survivor. If the old age person dies, then the spouse gets this for those 4 years, and then he or she will get their own old age security. So this is these are the other elements of old age security. Hopefully that makes it clear. The next we'll talk about is Canada Pension Plan. CPP, you do contribute to it. Each employer and employee contribute into it, and you do, it depends on what is your income. If your income is over $3,500 a year, then you contribute into CPP up to a limit. Right now it's around $50,000 limit. So below that, then you contribute to CPP. When you So the benefits you can apply between age 60, 59 to 70. So 10 years you have in between when you can apply. Most people will apply age 65, but you can apply anytime between that time. And you can receive the CPP while you're working also. Then when you contribute to CPP, it goes to the post-retirement benefit, the PRB. And the benefits for CPP are around $1,175 a month is the maximum you could get. So roughly $1,000. So as you can see, $1,000 for CPP plus $600 from the old age security, that's $1,600. These days in 2020, that is not going to take you very far. So, and then this is taxed also, CPP is taxed. So you can apply between age 60 to 70, like we said, if you apply early, your pension will be decreased by 0.6% per month of early pension. And if you delay it, you will get 0.7% per month delayed beyond age 65. So let's suppose Alice delayed her CPP payment for 14 months. She will get 14 times 0.7%, which means 9.8% extra payment. If she was going to get $698, then after 14 months, she will get $698 plus 9.8%. She'll get $766 payment. So with CPP, we said there is a pension, there is disability also. Anybody becomes disabled who's contributing to CPP, they will also get that benefit. And then there's a survivor pension, and there's a death benefit up to $2,500 maximum. So hopefully that is clear about the government pensions. Now for the employer, there are many types of company retirement plans, but they come under mainly these types. One is the defined benefit plan. In the defined benefit plan, the pension is known. You know how much you will get. There will be some formula. Usually the formula can be one of these. It'll be either a flat benefit. They just say this is how much you're going to get. Simple as that, depending on how many years you worked. But that doesn't really help because maybe somebody's earning more, earning less, they get the same amount of pension. So the career average takes an average of your income, and based on that, they will calculate how much pension you will get. That is the career average. And then the final average takes into consideration how much you earned in your final years of income. And that is the calculation that they will do. So it depends. If you earn more money, you will get a higher pension. And then there's individual pension plan. This is usually for directors and senior management in a company. This is an extra pension which they can get also, but most people will just get the regular one. The other one is the deferred profit sharing plan. In that one, the company only puts in money whenever they get a profit. Then there's defined contribution plan. Under defined contribution, you don't know how much you will get. The benefit is unknown. The employee makes the investment decision. So here, it could give you more, it could give you less than the defined benefit plan. It depends on the situation. It depends on how well your investments grow. So these are your examples, and like we mentioned already, individual pension plan, it could be a separate or it's actually a type of defined benefit plan. So the general information on pension plans is that there's a plan sponsor, that is the employer. They are the ones who will be enrolling the new people, issuing the pension statements, etc. And then plan members, they are the employees. So of course, in the employer and the employee, they're contributing towards the pension, and then at pension at age 65, the pension is paid out. The other option is that if you leave the company before your pension, if you work with the company for suppose 10 years, you start at age 25, now you're age 35, you're leaving the company. If you leave after 2 years with the company, usually you will get all the money from the employer and employee, both your contributions and the company contributions. So there could be $40,000, $50,000 in your pension plan. You can transfer that to a LIRA account, a locked-in retirement account. And then this goes to a LIF or LRIF. The names are different based on which province you're in. Between ages 55 to 71, you can convert this LIRA to a LIF account. The purpose of the LIF is that it gives you a pension. You have to take out money from the locked-in account when you have converted to a LIF account. Same thing if you leave the company before 2 years, you can only transfer your own contributions. You don't get the employer contributions. So it's a good idea to stay with a company for more than 2 years. In that case, you only transfer your money and then you will get the pension. So that is a general concept about the company pension plans. So we said there's a defined benefit plan. In this one, simply the employer must contribute. They can't opt out of it. And if the employee contributes, it's called a contributory plan, and the employee will get a higher pension. If the employee does not contribute, it's called a non-contributory. And the member makes no investment decisions. You don't decide how to invest it. The company has to do everything. They will give you your pension, regardless whether investments do good or bad. They have to pay you the pension based on the formula. The formula is known in advance, and it lasts for life. So like we said, it could be average of the career earnings, it could be the average of final career earnings, or it could be flat benefit. It usually pays a fixed amount to the spouse if the person dies, or a commuted value to the beneficiary. And of course, it is taxed. And then for the defined contribution plan, both the employer and the employee, they contribute, and the member makes the decisions on the investment. So it depends on what you're investing it in. The pension is unknown, and it depends on the performance of the investments. And it is taxed, of course. And so in this concept, you need to understand that, these things are very important to understand for your retirement planning. Hopefully this makes it more clear about, what is the benefits and how you can benefit from these, all these different types of plans. The individual pension plans, also deferred profit sharing plan, that one also, they are, other plans, but these are the main ones which you should know about. So hopefully that gives you a better idea about this, and you can plan for your retirement and enjoy retirement life properly. Have an excellent day.